Welcome to Iron Financial. We're here to help you forge a stronger portfolio. How do we do that? By stress testing companies and cutting right through the market weakness. Today, we are putting Nature's Sunshine, ticker NATR, directly under the microscope. Look, the market absolutely loves their latest earnings report, but our job isn't to follow the herd. Our job is to determine if this company is actually built with steel beams or if it's just a house of cards waiting to collapse. Let's get to work.
So, this is the central question for today, the one we're going to hammer on. A health supplement company drops a monster earnings report, and the stock pops. Now, the easy money, the lazy money says jump on board. But here at Iron Financial, that's not what we do. When we see a big headline beat like this, we grab our tools. We're going to inspect the foundation, we're going to check for cracks in the walls, and we're going to see if the roof can actually withstand a storm. Is this a truly solid structure, a real tangible investment opportunity, or is it something else, a cleverly disguised market trap just waiting to spring on you? We're about to find out.
And this is the market's first verdict, delivered in literal seconds. The moment those earnings numbers hit the wire, the stock jumped 4.5% in after-hours trading. Now, that is a strong, immediate vote of confidence from Wall Street. But what we know and what you need to know is that the market's first reaction, it's often driven by raw emotion and by algorithms, not by deep structural analysis. This initial surge is the flare in the sky. It's the signal that tells us it's time to dig deeper, to go way beyond that knee-jerk reaction and find out what's really holding up that price. Okay, let's get into the catalyst. This is the number that got everyone so excited. Wall Street analysts, the so-called experts, were modeling 19 cents per share in non-GAAP earnings. Nature's Sunshine came in and just blew that away, delivering 30 cents. I mean, that's not just a beat, that's a 58% demolition of expectations. It is an impressive headline, no question about it. But wait, hold on a minute. A single number doesn't build a fortress. Are we absolutely sure this massive earnings beat isn't just papering over some really serious structural flaws somewhere else in the business? Profit is great, but we need to know if the rest of the building is actually sound before we start calling it a skyscraper.
Exactly right. And that's why we have a process. This is our blueprint for today's analysis. We are going to conduct a full structural inspection, top to bottom. First, we're checking the top line. You can think of that as the revenue foundation. Then we go under the hood to look at profitability. That's the engine room. After that, we examine the growth engines. What is actually driving this thing forward? From there, we move to what I think is the most critical part, the balance sheet, or as I call it, the fortress inspection. And finally, we will assemble the final blueprint and deliver our verdict. Let's get started.
All right, section 1, checking the top line. We are looking at the revenue foundation here. Let's be crystal clear. Sales are the absolute bedrock of any company. If the revenue isn't growing, if that foundation isn't solid and expanding year after year, then the rest of the structure is completely irrelevant. It doesn't matter how profitable you are on a shrinking business. So let's see just how strong this base really is.
Let's start with that foundation. For the fourth quarter, you can see net sales grew from about $118 million to almost $124 million. Okay, so that's a 4.7% year-over-year increase. Now, let's be honest, this isn't explosive, 10-bagger hypergrowth. This is steady, it's solid progress. This is a company methodically expanding its base, brick by brick, laying more concrete. In a brutally competitive market like health supplements, consistent, positive growth like this is the very first sign of a well-built structure.
Steady? Come on, 4.7% isn't exactly a number that gets my pulse racing. In this market right now, if you're not growing at a much faster clip, you are at serious risk of being left behind by hungrier competitors. Is single-digit growth really something to get excited about? It feels like a pretty weak foundation to me. You know, that's a fair point if you only look at one quarter in isolation, but you have to pull back the lens and look at the entire structure being built. For the full year, they hit a record $480.1 million in sales. That's up 5.7% from the previous year. This wasn't just one decent quarter. It was their best year of sales ever. This isn't a sign of weakness. It's a sign of methodical, sustained construction.
With a solid revenue foundation in place, it is time for section 2, profitability under the hood. A strong top line is absolutely crucial, but, it's only the start of the story. The real strength, the power that actually drives shareholder value, that comes from the bottom line. How much of that revenue actually turns into cold, hard profit? This is where we see if management is running an efficient machine or if they're just burning cash to chase sales. So let's pop the hood and check the engine.
And this right here brilliantly illustrates the point. This isn't just a simple tune-up. This looks like a complete engine overhaul. A year ago, in the fourth quarter of 2024,
They were actually losing $300,000. Now, fast forward to today, they've swung to a $4.1 million profit. This is the real story behind that huge EPS beat we saw just a minute ago. It's a dramatic night and day reversal from burning cash to generating it. This tells me their operational improvements are really taking hold and creating real structural power.
You can see that efficiency right here. Gross margin expanded by 50 basis points to 72.5%. That means they're making more profit on every single product they sell. They're optimizing costs, they're managing their supply chain. This is the sign of disciplined operations. But wait, hold on. You can't just cherry pick the good number on the slide. I mean, look at the line right below it. Selling general and administrative expenses. We call it SG&A. This is basically the cost of keeping the lights on and marketing the products. Well, it jumped by nearly 11%. That's more than double their revenue growth rate. How can you sit there and call them efficient when their overhead costs are ballooning like that? To me, that looks like a major crack in the armor. They're having to spend way, way more just to keep the lights on. You're focusing on one expense line in one single quarter. And frankly, that SG&A spike is exactly what I'd expect, what I'd want, to see from a company making strategic moves. They attributed it to timing and, more importantly, to digital investments. You got to think about it. Building new e-commerce platforms, launching huge digital marketing campaigns. That costs money up front. It hits the SG&A line before it generates revenue. But I'm looking at the total output of the machine over the long haul. And for the full year, their adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key measure of core operational profitability, it grew by a massive 21.7% to hit $49.4 million. So you see a potential leak, I see them investing in a more powerful engine that's already generating significantly more horsepower.
And that actually brings us perfectly to our next section. We've seen the top line growth and we've seen the bottom line power. So now we need to understand exactly where that growth is coming from. What are the specific engines driving this business forward? We need to dissect the company's performance by geography and by strategy to see which parts are firing on all cylinders and which parts might be sputtering.
Okay, so this slide gives us the geographic breakdown for the fourth quarter. It is crystal clear that Asia is the dominant force here, making up 45% of their sales. It is their single largest market by a long shot, followed by North America at 30%, and a really solid 20% coming from Europe. So what this tells us right off the bat is that their success is heavily, heavily dependent on what happens in the Asian market. It's the main pillar supporting the entire structure.
Whoa, hang on a second. This is a huge red flag. You just said that Asia is the main pillar, that it accounts for nearly half their business. And this chart shows that pillar is actually shrinking. Sales in Asia were down 1% year over year in the fourth quarter. Meanwhile, Europe is just exploding with 18% growth. How can you possibly call this company a solid structure when its biggest, most important market is literally showing signs of decay? That's not a small crack. That's a potential stress fracture in the main support beam of the entire building. Because they're not just relying on old support beams. They are actively retrofitting the building with new, high-strength materials. While the traditional business in Asia saw some softness, you have to look at the new engine they are firing up. This is the digital acceleration. In the fourth quarter, new customers acquired through their digital channels were up an incredible 98%. 98! And that drove a 47% increase in their total digital business. This is where the real power is coming from now. They are building a modern, powerful new engine that is more than compensating for softness in older parts of the business. This isn't a sign of decay, it's a sign of smart, deliberate evolution. That digital engine is impressive, I'll grant you that. But it needs to be built on a solid chassis. And that brings us to Section 4, which I believe is the most critical part of any corporate inspection, the balance sheet. This is where you separate the durable, all-weather companies from the ones that are just built on flimsy credit. We're about to kick the financial tires hard to see if this company is built to withstand a recession, or if the first sign of trouble will cause the whole thing to collapse. So is this a fortress, or is it just a facade? And the answer is unequivocal. This right here, this is the steel frame of the company. Just look at these numbers. They are sitting on nearly $94 million in cash and cash equivalents. And even more importantly, look to the right, zero. They have absolutely no debt. In a world of rising interest rates and deep economic uncertainty, having no debt and a mountain of cash is the ultimate sign of financial strength. This company can fund its own growth, it can weather any storm, and it can seize opportunities without ever having to ask permission from a bank. This is, by definition, a financial fortress.
And this fortress isn't just a static defense. It's not just sitting there. It is an active, cash-generating machine. For the full year of 2025, their free cash flow was $28.8 million. Now look closer at that number. It more than doubled from the $14.3 million they generated just 1 year before in 2024. They are not just profitable on paper. They are stacking physical cash at an accelerating rate. This is the lifeblood of a healthy company, and right now it is pumping harder and faster.
Okay, a fortress full of cash is great, but a dragon sitting on a pile of gold doesn't do its shareholders any good. What are they actually doing with all that money? Is it just sitting in a bank account collecting dust while the business could be expanding faster? That's the key question, and this slide is the answer. They have a clear, balanced, and very shareholder-friendly capital allocation strategy. Look, they returned $16.3 million directly to shareholders last year through share repurchases. They're reinvesting in the business by improving their supply chain and funding that organic digital growth. And they're actively looking for strategic acquisitions to expand their empire. Plus, they still have another $17.4 million authorized for buybacks. They aren't hoarding cash, they're deploying it like a disciplined general on a battlefield.
All right, this brings us to the final section. We've inspected the foundation, we've checked the engine, we've looked at the growth drivers and the fortress balance sheet. Now it's time to assemble the final blueprint. We're going to synthesize all of this data, look at what management expects for the future, and finally answer our initial question. Is Nature's Sunshine a solid opportunity or a dangerous trap?
You know, the best way to judge a company's future is to see what they promise publicly on the record. This is their official guidance for 2026. They are projecting net sales between $500 and $515 million. Now, crucially, the midpoint of that range is actually above the current analyst consensus. That tells us that management is more confident than Wall Street is. They also expect adjusted EBITDA to keep growing, targeting a range of $50 to $54 million. This is not a company that's bracing for a slowdown. This is a company that is planning for continued steady construction.
So let's lay out the bull case, the argument for strength. First, you have that dramatic surge in profitability, turning a loss into a significant profit. Second, the fortress balance sheet with nearly $100 million in cash and zero debt. That provides immense stability. Third, they've ignited a powerful digital growth engine that is actively modernizing the entire business. Fourth, Europe is on fire, growing at 18%. And finally, management has issued confident forward guidance that beats expectations. When you assemble all of these pieces, the blueprint looks like a very well-constructed, resilient business that is built for future growth.
Okay, that's the optimistic view. But this blueprint is not perfect. We absolutely cannot ignore the potential stress fractures. First and foremost is that slowdown in Asia, their largest and most important market. You simply cannot brush that off. Second, those rising SG&A costs are a real concern. They're outpacing revenue growth, which could easily eat into future profits if it's not managed. Third, they are now heavily dependent on keeping that incredible digital momentum going. I mean, really, can a 98% growth in new customers be sustained? That's a huge question mark. And finally, let's not forget they operate in the hyper-competitive, shark-infested waters of the supplement market. These are the risks that could undermine the entire structure.
And so we come to the final verdict. On the one hand, you have a company with a rock-solid, debt-free balance sheet that is generating cash at an accelerating rate. Profitability has surged, and a brand-new digital engine is roaring to life. That, my friends, is the definition of a strong financial structure. On the other hand, there are visible cracks. The slowdown in their largest market, Asia, is a serious concern, and those rising costs need to be controlled. The ultimate question you have to ask yourself is this: is their new digital growth a powerful enough reinforcement to offset the weakness in their traditional foundation? The market's initial 4.5% jump says yes, but the real test will be whether that digital engine can continue to fire on all cylinders, quarter after quarter. Is it an opportunity or a trap? The foundation is undeniably strong, but you have to be confident that the new construction can support the building's future growth. That's the question every investor has to answer for themselves.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.